Hello and welcome to today's video. Gold, silver, wheat, rice, food items. Wow. Basically, it's the entire world is open for us for investing, isn't it? Basically, investing in agriculture or natural resources, that's a wide range of investment opportunity open for us. Things we can think of like tea, coffee, we eat like rice, wheat, butter, anything, cattle stock. Things we don't eat like cotton, lumber, linen. Wow. Even natural resources like oil, gas, so on and so forth. That's a huge market. In this video, we'll see why a fraction of your portfolio should have these investments. And having them, how it helps you balance your portfolio and its risks. Like and subscribe this video right away so that this video reaches a lot of people. While these investments are becoming more of a mainstream investments, it does make sense to have a certain amount of these commodities in your portfolio. But before you jump into it straight away, you should know what you should be expecting from these commodities. In India, there are 3 primary commodity exchanges which allows you to trade in these kind of commodities. MCX, which is the Multi-Commodity Exchange. NCDEX, which is the National Commodity and Derivative Exchange, and ICEX, which is the Indian Commodity Exchange. And if you do not want to use any of these exchanges, you can invest in these commodities through the commodity mutual funds and the ETFs that are available. So options are there. What you would choose is what we are going to discuss and why we need them. Now let's consider you are choosing to trade. What can you do? Say suppose it's an arbitrary number, you know these figures are not right, but say suppose you are choosing to trade 10 kilo of gold in some future date for 50,000 rupees. Say the date is approximately 1 month from now. On entering this contract, you are agreeing to buy the said quantity of gold, which is approximately 10 kg of gold in 1 month from now at 50,000 rupees. You are agreeing to this contract price. Now, say suppose you hold on to this contract till expiry of this contract, which is 1 month from now. The seller of the commodity is bound to deliver the physical quantity of that good to you as per the contract and at that price. Now, the second way is you can trade off this contract and sell it off to someone else who needs it, and in between just buy, make some quick profit. The second way is to trade this contract off for some quick profit before the contract expires. Now, in doing so, what happens is you do not take a physical delivery of the goods, that's one, and also you make a profit out of this transaction. But having commodity in your portfolio, how do they benefit you and your portfolio as a whole? Now see, commodity it's something which does not depend on the stock market. It does not depend on the stock market movements. What it depends on rather is the demand and the availability, the demand and the supply of the goods. So if a commodity depends on the demand and the supply of the good, the price of a commodity would rise if the supply is less, and it would fall if the supply is more than the demand. So which means you see they don't always move in tandem with the market, because the demand and the supply doesn't depend on the market. Market moves due to business performances, and the demand and the supply of a particular commodity moves because of the demand and the supply. So they may or may not be in tandem with each other. Now, what is one good advantage of holding a commodity? See, a commodity is a good. A good will not go bankrupt like a stock. This factor itself is so good that, since it cannot go bankrupt, the value will never be zero for a commodity. Unlike a stock which can go bankrupt and take all your money away. This very fact makes it a very safe investment option than bad stocks. And hence, since they do not move as per the stock market, they can become a hedge against a bad falling market or a recession market. In fact, it can so happen that when a market is flat, there is no movement in the market, you can still see spikes in the commodity market, be it on the either side, be it on the higher side or on the lower side. So a very carefully chosen basket of commodities is worth considering for your portfolio. Well, historically, it's seen that the commodities have performed well during the inflation period when the stock and the bond market have lost value. Well, having said that, it's not all sunny. When we understand that the commodities does not depend on the market and the market movements, it depends on the demand and the supply. It can happen so that the demand and the supply can make the commodity very, very volatile at times. And this can contribute to a huge loss of your money. In mutual fund investing, in stock investing, in international investing, the fund managers or the investors have a wide choice of investing in different stocks of different countries, in different economies, and try and rebalance the portfolio. But in commodities, this kind of option is not available. The vast array of options is not available in commodities. There aren't many companies to choose from in the commodities world. So suppose in a big pandemic, livestock gets a hit. Like widespread health issues have curtailed the livestock quality. It can bring in spike as the disease can spread amongst the livestock and bring in spike in the stable livestock market. Like global economic developments in India and China has increased the supply of raw materials in India and China, whereas it has become a shortfall in other parts of the country or in the other parts of the world. So these are some of the disadvantages of entering into the commodity market. Well, now, since you have seen the advantages and the disadvantages, let's see whether you should still choose to invest in one of these commodities, and if at all you make it a choice, what should be your next steps to follow. Choice number 1, using the futures contract. We just explained earlier that you enter a contract to buy a particular commodity at a particular price in a future date. So that's a contract. This is one option you can choose to enter the commodity market. Using options, instead of directly entering into the commodity or in the future contracts, many prefer to invest in companies which are involved in commodity mining, commodity trading. Like you may buy stocks of oil drilling companies, mining rigs, and all of these companies who are involved in extracting raw materials from earth. You can purchase stocks of these companies instead of directly entering into the commodity market. You can choose to have these options. The exchange traded funds and exchange traded notes, these allow investors to profit from the fluctuations of the price without investing in the commodity futures directly. Though we know that the ETFs and the ETNs, they track a wide range of commodities, so a major movement may not be tracked or may not be possible. They may not reflect a big move in the price of the commodity. Mutual funds and index funds, well, you directly cannot choose a mutual fund who invests in commodities. That doesn't happen. But you can choose mutual funds who invest in companies who are involved in commodity trading or maybe involved in mining, extracting raw materials, or like oil companies, agriculture, mining companies, etc., and so on and so forth. The next option is CPO, commodity pool operators. Like these are the people who pull in money from different investors to invest in commodity futures. So this is also an option which you can choose to invest in commodities. So to sum up, the commodity investing is a bit riskier than stock investing because we really do not know what the demand and the supply would be for a particular commodity in this market. And hence it makes it very, very difficult to understand the trend. Just imagine to predict a pandemic, to predict a natural calamity, a natural disaster, which would increase the demand of a particular commodity by few thousand times. It's really difficult to predict. You cannot know what's going to come up next. And hence, since we cannot predict what's going to come up next, since we cannot predict the nature, we cannot predict what natural calamity will come up next. And since we cannot predict what natural calamity will come up next, we cannot predict what or how much spike a particular commodity will have when it comes. And since we cannot predict that, we cannot predict what our returns on investments would be. It's all interlinked, see? But one thing is very good. Since commodity is a finite good, and with the increase in the world population, and the product is finite, the demand for a particular commodity will always rise. And since the global demand increases for these raw materials, for these commodities, it will increase the production cost, it will increase the cost of extraction from earth, it will increase the cost of their value as a whole. Well, in general, commodity prices are really volatile. But choosing stable commodities which have given historically positive returns over the last decades can help grow your portfolio by a good margin. Of course, as long as you diversify your investments well to minimize the risks. That's all for today. See you again in the next video. Till then, SG signing off. Goodbye.